Joe Libben here. Welcome to The Way Home, the next edition in our weekly installment of your pathway to home ownership. This week, we're going to talk about credit scores, your FICO score, and what determines the credit score. First of all, there's actually three scores. We pull what's called a tri-merge credit report. They throw out your high score, they throw out your low score, and it's the middle score that counts when we're looking at approving someone for a loan. So what makes up those factors? As it says here on the chart, 35% of what determines your credit score is actually how you pay your bills, your payment history. So obviously paying your bills on time is a very big deal and allows you to get the highest score possible at 35% of it. Next up, 30% is the amounts that you owe. It's not just how much you owe, but what types of accounts and the percentages available of the credit that you're using. So this is when they're talking about credit cards. If you have a lot of money on credit cards, it's super important to keep the balance at or below 30% of the limit. So if the limit's $10,000, you don't want the balance to go over $3,000 or 30%. You're actually better to have multiple credit cards where the balances are below 30% than just one credit card that's maxed out. And again, that's 30% of what determines your credit score. Next up, 15% of your score is determined by the length of time you've had credit. And so this is, for somebody who's younger, who has what's called a thin file, not a lot of trade lines, and they don't go back very long. That's why their scores are lower, and you'll find scores are higher for people that are older because they've had credit a lot longer. And again, that's 15% of it. Not much any of us can do about that. That's just the time that we've had credit. Next up, 10% is determined by your new credit. So when you pull something new and the type of credit, that controls 10% of the score. And then finally, 10% is the type of credit that's used. And again, this kind of ties back into credit cards versus installment loans. Credit cards being revolving, installment being set payments for a set amount of time. So the magic formula is to have at least 2 revolving and 1 installment. And as long as you've got at least that, you're on the path to having great credit scores. Of course, paying on time is the #1 thing. So hope this helps you. If you have questions or need anything else, please call or text me at the number below. Thanks for watching, and we'll see you next week.